Good morning, everyone, and welcome to the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Associate Rob Knapp, and it's great to have you with us this morning. We are going to get right to it this morning. There's a lot to talk about. We have a new jobs number, 187,000, a little lower number than we're used to seeing, but still in positive territory. We also want to talk about the recession possibilities. There's been a recession on the horizon, allegedly, for a while. Our executive director, Greg Brown, is going to be along in a moment. In addition to the jobs number, he's going to give an update on what the economic figures are telling us about the possibility of a coming recession. So all of this coming up next. After that, your questions will be answered by Professor Brown. You can submit them at any time using the Q&A function at the bottom of the screen. If you have a question right now, go ahead and put it in. We will try to get to all of them during the 30 minutes that we usually have allotted. If it comes in near the end of that 30 minutes, it might make it a little hard, but we'll try to do all of them. If you're joining us by phone today, you can submit your question by email to me at rob_knapp@kenan-flagler.unc.edu. We do prioritize questions from the press, so if you're a member of the media, please remember to include your organization with your question when you submit it. I think that's everything I need to tell you. We're going to jump right into it. So let me welcome our Executive Director, Greg Brown, who's going to give us analysis of this morning's job numbers and some other things of economic interest.
Thanks, Rob. Yeah, so interesting jobs report this morning. The non-farm payrolls number, of course, the one people key off of most, I would say came in basically in line with expectations. If you look at sort of the range of forecasters, it was, they were mostly in the 150 to 250 range. So I think this 187 number is pretty consistent with what people were looking for. But there's always interesting detail inside. We did see downward revisions for the past 2 months. Nothing too exciting, down about 50,000 for the May and June estimates, but again, still reasonably strong numbers for both of those months. Perhaps the most interesting number is the hourly earnings numbers that came in a little bit stronger, and we'll dig into that. I've got a couple slides to look at some more detail there. And also, we've been, especially the Kenan Institute here, we've been keeping a close eye on labor force participation rates. I want to dig into a little bit more understanding about where we think that is on a cyclical basis right now. So, just looking at longer term trends, we've definitely seen a softening in the payroll numbers, where numbers that were up in the 500,000 a month range in 21, and then cooling down to 300,000 range or so on average in 22. I've kind of leveled off the last few months in the 200,000 range, or just under 200,000 range. So clearly that's cooler than what we've seen previously. But I think the flip side is that those are still pretty strong numbers. Like if you were to think about a pre-COVID world and looking at employment numbers that were coming in consistently at 200,000, you'd say that's a pretty strong economy. So, of course, there's momentum in macroeconomic data. So, it is to some extent important what's happened over the last year or two. But at the same time, the labor markets appear to remain very strong. And that is, I think, importantly, continuing to be reflected in average hourly earnings that are strong and in this case above expectations. If we look at sort of overall payroll numbers, this aggregate weekly payrolls number, we have the first number now for Q3, sort of suggests that there's a good mapping of that number into GDP growth, that we would be starting the third quarter in what appears to be a pretty strong position for Q3 growth. So the unemployment rate ticked down slightly. That comes from the household survey, which is entirely independent of the establishment survey, but we continue to see strength there. Again, this is basically the lowest number we've had for unemployment rate over the last 50 years. It's been bumping around that 3.5% or a little bit higher range now for some time, and that's largely due to the fact that we've continued to see people re-enter the labor force. So we can have very strong job growth and not be too worried about it if we have lots of people coming back into the labor force. And in fact, that's what we've had. We've had millions of people come back into the labor force over the last year. If we look at prime age workers in particular, we're now at the place where men participation in the 25 to 50-year-old age group is back to where it was pre-COVID, and women is well above where it was pre-COVID, and really the highest it's ever been in U.S. economic history. So I think as from a policy perspective, we think about how is the Fed going to look at this data. They've got to be increasingly concerned about, if we see continued job growth in the 200,000 range, how are we going to come up with those people? They need to come from somewhere, or else you're going to see an unemployment rate that gets even lower, a labor market that's even tighter, and wage growth that could be even more worrying from an inflation standpoint. Yeah, so just to recap that last slide. So, unemployment rate, again, basically a 50-year low, and thinking about where the employees are going to come from. The labor force participation rates are just extremely high for what we think of sort of important segments, and what are called prime age workers, the 25 to 54-year-old workers. Now, the overall labor force participation rate is not back to where it was pre-COVID, but we know that that's because we had older workers, 55 and older, leave the labor force, and they're just much less likely to come back over time as these prime age workers move into that larger age group. We'd expect that older worker group to go back up, but we're not expecting people, at least not a large number of people who left the labor force who are over 55 to come back. They're sort of permanently gone. So I think this has the Fed. If I were a Fed economist and looking at the data, I'd be increasingly concerned about whether we can sustain job growth in the 200,000 range. A few things on the other side of the equation that there maybe point towards a bit of softening. We continue to see the temporary employment numbers decline. They're thought often as a leading indicator for what's happening in the broader labor market. Kind of first to be hired and first to be laid off. Temporary workers fell another 22,000. That's been a trend for almost a year now, and so a sign of, again, potentially some cooling. We also have seen that in the manufacturing employment. So there was a forecast for a slight increase in manufacturing for July, but the print on it was actually slightly negative. And as we continue to think about how the Fed might consider these data, the employment levels are just really high right now in the U.S. We compare this to the Fed funds rate on an inflation-adjusted basis, which is, we should think of Fed policy, the real rate or inflation-adjusted rate being the one that's relevant. There's still some evidence that the Fed could be behind the curve. If we go back to the Gulf War recession back in 1990 and the dot-com bubble bursting and the global financial crisis, in each of those cases, the Fed had raised the real Fed funds rate to a level that's quite a bit higher than what it is right now. And of course, the unemployment rate is even lower than it was prior to those recessions. And so in this sense, you might expect that the Fed potentially still has more work to do on the rate side. But it's not sort of an obvious case when you look across different sectors in the economy. If we look at the ISM numbers, these are surveys of purchasing managers in both the service sector and the manufacturing sector. We see different stories here. We see what appears to be, again, sort of some cooling, clear signs of cooling in the manufacturing side, but continued strength in the services side. So which of these is going to be more important? Manufacturing's historically more cyclical, but services is a larger chunk of the U.S. economy, of course. And so it's, again, not clear sort of where we are from a cyclical standpoint right now by looking at those. And what it really is going to come back to for the Fed is what's happening to inflation. And people have gotten really excited about the potential for a soft landing, and essentially that means avoiding a recession, because there has been good progress on the inflation front. So the inflation numbers are cooling, and we can look at those at a year-over-year basis, or a 6-month annualized basis, or a 3-month annualized basis. They seem to be continuing to move down, trend down. But it also, that rate of decline has leveled off, and it's leveled off at an inflation number that is above the Fed's 2% target. So if we don't see more progress on inflation, then that would suggest the Fed needs to do more to get to their 2% target, or change their target. Of course, there's some people out there that think the Fed might be okay with 3% inflation versus a 2% target, even though that might not be a public stance for the FOMC. So how should we think about the economy moving forward? What's the probability of a recession? I think the probability of a recession in Q3 and even Q4 is probably very low. I think the folks here at the Kenan Institute who have looked at sort of a probability of recession, say over the next 12 months on a rolling basis, have thought the Fed probably does have more work to do, that inflation is quite persistent, that the economy has continued to be stronger than what people have expected, and that strong economy could translate into higher rates by the Fed and eventually tipping the economy into a recession. So I think, from our view, we're not out of the woods yet in terms of a risk of recession over the next 12 months. Not worried about things right now. In fact, maybe the opposite situation right now, that the economy remains quite strong. We, lots of signs of continued growth in Q3 and Q4. And I think the Fed's going to need to see more of a decline in expected output, and in particular, how that might relate to wages and inflationary conditions before they're really going to feel like their job is done. If we look at the Fed fund, so one other indicator for why the economy might be have continued strength through the rest of this year is that we've still seen strong household wealth numbers. If you look at things like the cash deposits and money market holdings by households, continue to be well above where we were pre-COVID, and so balance sheets and income for households are strong. And if we look at the Fed funds futures, I realize it's a little hard to see this, but the orange line is the expectations for Fed funds rates as of this morning after the employment report came out. The green line is yesterday and the blue line is a month ago. So again, not a huge increase in expectations for Fed funds rates, but ticking up, and there's been a continual movement up in terms of what expectations are going to be for Fed activity. So if things don't cool off and the Fed is going to have to continue raising rates, that suggests that there's an increased risk of recession towards the end of the next 12-month period, not necessarily this calendar year. So really, just to kind of wrap things up, I think our view is the current economy is strong, potentially too strong, stronger than the Fed would want. Employment numbers point to that. Consumer cash and balance sheet points to that. Retail sales numbers we got recently were strong. Housing starts are rebounding. Consumer expectations are rebounding. The case for a softening or a soft landing is that there's sort of mixed evidence on business sentiment and the ISM. The JOLTS numbers, these are the job openings numbers, have come down a little bit, but at the same time they're still really strong. They're still quite a bit stronger than they were prior to COVID. Consumption has numbers have cooled a little bit, but again, still very strong, consistent with above trend GDP growth. We've seen some softening in bank activity, lending activity. The yield curve seems, to continue to point towards softening with its inversion. Industrial production, manufacturing is weaker, and of course, when you look at some of these composite measures of leading indices, that they're weaker. But it's definitely a mixed bag from our perspective. It's going to be very interesting to see what kind of data we get over the next few months. The Fed will have another look at employment data before they make another decision at the August meeting. But I wouldn't be surprised if there's real concern among Fed economists about what's happening on the wage front and what that means for inflation expectations going forward. So that's our view on the economy. In a nutshell, continued strength, maybe too strong, maybe continued Fed tightening that would lead to a recession at the beginning of next year. Of course, the question isn't, will there be a recession? It's when will there be a recession? And, as people have backed away from recession forecasts in the near term, it doesn't mean there aren't longer term risks to a slowing economy. So I'll leave it there, and Rob, happy to take questions at this point.
Okay, great. Thank you very much. Like Barbenheimer, a mixed picture, I guess. So consumer confidence, I would imagine all the talk of soft landing is going to help consumer confidence. That plays into this by expectations, more spending, that sort of thing. Good thing, bad thing? I find myself asking that question a lot.
Yeah, I mean, so better consumer confidence, which we've seen, should translate into higher spending activity. Is that a good thing or a bad thing? I mean, if you like economic growth, that's a good thing, right? That's a sign of strength in the economy. But is that what the Fed wants right now? Right? My view is, like, forget about what's happened over the last year, for example. Just take a snapshot, the data that we see, right now, looking at the economy. By sort of almost any measure, it's a very strong economy, right? It's an economy that looks like it's hot, too hot by sort of historical Fed standards, and that would suggest that there's a need for the Fed to go higher. What tempers that view is that the Fed has already raised rates quite a bit. We know that their actions act with a lag, and then we've also seen some slowing in sort of a downward trend in a lot of numbers, like employment numbers and manufacturing numbers. And because of that sort of persistence, that momentum in the economy, that tempers the view of a very hot economy, just the snapshot of a very hot economy right now. So the Fed's certainly going to keep an eye on what's happening with consumer sentiment, because consumers are 2/3 of the U.S. economy.
Okay, thanks. Let me remind people too, you still can submit your questions. You can do that using the Q&A function at the bottom of your screen. If you're with us by phone, you can email them to me, rob_knapp@kenan-flagler.unc.edu. We probably have room for another question or two if people have them and want to ask them. Let me ask one here from Andrew Jacobson. How does immigration policy play into the employment scenario, and can there a case be made for the Fed to become an advocate of using immigration policy as a tool?
Sure, yeah. I mean, this goes back to the question of where the worker is going to come from, right? If we continue to see job growth and the payrolls numbers of 200,000 a year, you either got to get people off the sidelines that are already here, or get them from other places, right? Mm-hmm. So I don't know. I mean, it's clearly a politically touchy subject around immigration, but historically we have had a significant number of people join the labor force in the U.S. that were immigrants, and that's slowed. I mean, during COVID and even post-COVID, the share of new entrants into the labor force coming from immigration has declined. It's well below its historical average. So I mean, it's a very viable place to get workers but it's not one that's been a big source recently. And I would, Fed economists might support that position. I doubt if they would do it too publicly.
Okay, thank you. Got a question from Barbara Senich, and it is a yield curve question. So I kind of wish that our chief economist, Gerald Cohen, were here, because I know his passion for the yield curve. Your data shows that the inverted yield spread, 10-year and 3-month treasuries, has been an excellent predictor of a recession. That said, the data suggests that the last 4 recessions began at a point in time after the yield curve returned to zero after being negative. Is this an artifact of how we recognize a recession, something else, or should we read more into this possibly expecting a recession shortly, timing-wise, after the spread presumably returns to zero, or is now different for some reason?
Yeah, that's a great question for Gerald, the big yield curve advocate. I mean, so I guess the question is in some sense, does the yield curve capture information about broader expectations around the economy? Is there some mechanical relationship that actually the yield curve is driving that, because the Fed's has more influence on the short-term rates versus long-term rates? I think the yield curve is continuing to tell us that there are recession risks on the horizon. There's no magical number in terms of what the lead time would be between seeing a yield curve inversion and a recession. But in some ways it's still a very logical way to think about what the risks are under the economy, right? People think that the Fed has current interest rates well above where they'll be in 5 years or 10 years. And so that's a sign of the Fed trying to slow the economy down. And historically, the Fed has tended to overdo it, or at least that's one way to read the relationship between an inverted yield curve and a recession. That said, it's been a bloodbath in the bond market this week, right? So long-term yields are now basically back to the peak that we saw last year. So there has been a pretty significant shift in the inversion this year as the yield curve has flattened, or sorry, this week as the yield curve has flattened. And the 10-year rates up around 4.2%, 30-year rates up around 4.3%, which is about where things were at the peak last year. So that flattening would be consistent with this notion of a soft landing, less of a chance of a recession based on that indicator, but it's still inverted. So that sort of just very simple measure would still point towards continued risk of recession, sometime over the next 6-12 months.
Okay. And Gerald is with us this morning and chipped in on the Q&A that he'll take a stab at it next month too. So I figured that might be the case.
Yeah.
A couple of people are asking about the Fitch downgrade. What do you see as the economic impact from that?
Yeah, I personally think it's a big nothing burger. It just doesn't. There was no new information that came out with that. I don't think Fitch has some crystal ball into the economy that other market participants don't have. So I just don't see how it has a meaningful impact on market participants, on way fiscal policy is conducted. Clearly the administration is trying to downplay it, and I think most private market participants just don't see it as an information event. If there was some fantastic new piece of analysis or information that came along with that report, but it's basically no news there.
Okay. This one's from David Hill at Triad Business Journal. What other factors do you at the Institute consider, such as world wheat prices because of Russia and student loan payments returning and the like?
Mm-hmm. Yeah, so if we look at what's been driving inflation down, over the last, say this calendar year. It's been energy and food prices have been important on the headline side. Some normalization of some of the supply chain problems. So those are things like that. These kind of global issues, I think, are important for what's happened to inflation this year. But increasingly, I think it's a story about wages and kind of structural underlying inflation. So wage growth that's very strong. We've certainly seen housing costs be an increasingly important component. That's a sticky component. A little bit hard to know exactly what the kind of current impact is of housing, just because of the way it's measured in the statistics. But if anything, the last 6 months or so has benefited from kind of these global forces on inflation. And those are probably going to moderate. I think the grain stuff is not a huge issue for the U.S. in particular. That's kind of rest of world type issue for Ukraine. Energy prices a little bit more important. But the supply chain normalization is interesting, right? I mean, we've gone from incredibly disrupted, tight supply chains to lots of slack, right? And we saw the bankruptcy of Yellow Freight. We've seen the cost of container shipments come way down. So on the goods side, it seems like, and of course, this is consistent with the decline we've seen in manufacturing in the U.S., that there's definitely a softening on the goods side of things.
Okay, thank you. It's yield curve Friday. There was a follow-up here that I missed from someone else, and pardon me if you touched on this on what you've said already, but in light of the strength of the economy, why has the yield curve stayed inverted for so long?
Yeah, because I think because people felt like the Fed had a really tough job, right? I mean, inflation was really, really high, right? Highest we've seen in 40 years. And, because inflation was so high, the Fed had a lot of work to do. They were going to have to raise rates to be much higher than what we had seen over the last, couple decades or so. And the expectation, around Fed credibility that they were actually going to do what it would take to lower inflation down to the 2% range. And long-term real rates have been in the 1% to 2% range historically. So if you believe a Fed inflation target of say 2% and a real interest rate of 1.5%, that gives you 3.5% long-term bond yield, and that's about where things have been hanging out for the last year.
Okay.
Until basically just the last couple of weeks where we've seen an uptick in longer term rates.
Right. Here's one from Mary Moore Hamrick. Talk more about sectors driving job growth, how job growth must be at levels greater than pre-COVID. Are there sectors of the workforce other than greater than 55 years that aren't returning to work? So you've addressed that part already, I think, but just in terms of the sectors.
One thing that I thought was quite interesting, in the report was just how strong healthcare was. I mean, almost half the job creation last month came in the healthcare industry. And that was an area that was really decimated during COVID, and saw lots of people exiting healthcare, real shortage of healthcare workers. So it's nice to see things where we would hope that the labor shortage in healthcare would start to work itself out, and that does seem to be the case. So that's one area that I feel it's nice to see strong job growth there, because we know we need people working in healthcare.
Okay, good. Let's do one more, and it's a capital question. So got to have one of those for you every time, I think. Let me just take a part of this. What are the more dominant strategies that investors have used, and ultimately, what are your views looking forward on, say, the private debt, equity, and other alternative products like real assets?
Yeah, I mean, the private markets, private equity markets in particular, have been really dislocated for the last year or so. And deal volume has been low. Exits have been really challenged. There's a huge decline in distributions out of private funds back to limited partners. When is that going to normalize? It's I think really hard to say. And for people that are in that space, that's a $64,000 question, right? Because people are over allocated right now because of so-called denominator effects, where public markets have declined more than private valuations. So new fundraising has slowed down, distributions have slowed down. What does it mean for returns? Again, it's hard to say. It looks like private credit has been able to weather the kind of uncertain financial conditions over the last year. There's a lot of concern a year or so ago about what softening economy would mean for private credit, given that it tends to be below investment grade debt. But we'll certainly be learning a lot more over the next year or so as I think markets normalize, valuations normalize, and we start to see what the exit market really looks like. Nobody is interested in doing exits right now, like traditional exits right now, because they don't like the valuations. But at some point, people are going to have to get out of these transactions. So going to be interesting to see.
Always is. All right. Thank you very much, Greg Brown, for answering a lot of different kinds of questions in a short amount of time. We appreciate it. Thanks also to our audience out there who came through strong with questions, as always. Big finish there, so we appreciate that. To all our media members in the audience, we'd love to continue the conversation. If you all would like to speak to Professor Brown, Dr. Cohen, or any of the rest of our experts, please reach out to me at rob_knapp@kenan-flagler.unc.edu. For all of you out there, we hope that you'll visit our website at kenaninstitute.unc.edu. We have a lot of things going on. We'll have even more things going on as the academic year gets into swing here, and we'll have more from the American Growth Project coming soon that I'm sure you're going to want to check out. So look for that. Also want to make sure to give a shout out to the folks whose faces you don't see on this briefing, but who helped make it happen. Cody Morris doing graphics today, Corey Powell with his fingers on the Zoom buttons, and Robbie Passel doing video editing and trying desperately to edit out my mistakes from this 30 minutes. So thanks to all of you. You make it happen. That is it for us today. We hope to see you back in September for another briefing. But for now, thanks very much and enjoy your Friday.